Also, news coming out at the close of business is that the Kenyan Central Bank has decided to leave its benchmark lending rate unchanged at 18%. Most analysts had expected that, saying more time was needed for past rate rises to have their full impact on the economy. Let's head over to Nairobi, Kenya, where Sunil Sanger, an independent financial analyst, is standing by. Sunil, thanks so much for your time. The decision to keep rates unchanged, was that wise and prudent on the part of the CBK?
I think this was largely expected by the market. I think there was a very severe monetary tightening which took place in the last quarter of 2011, and it's possibly just starting to take effect now. I think we've seen lower credit growth in the quarter of 2011, and the exchange rate also seems to have appreciated and now stabilized at lower levels.
What are the factors that the CBK's had to consider? Because some would argue the highest levels of inflation should be a worrying figure for the CBK. Others say stabilizing the currency should have been the priority, and that's always been the priority.
I think inflation has been one of the key factors, and the sharp increase that we saw over all of 2011. Finally, inflation seems to have topped off in December. I mean, after continuously increasing for 13 months, we finally saw a small decrease in December. It looks like with the rise that we had in the November-December period that food supply seems to be increasing and food prices are stabilizing or declining marginally. So we may have seen the top of inflation. Currency continues to be concern, and I think with the current account deficit we would possibly see some slippage in the exchange rate in the next few months.
Authorities are bullish though about recovery in general in Kenya, and we're already told that the forecast by the central bank is that inflation could be at around 9% in June, and the indications obviously are the declining costs in food because of the rains coming through, and that will have a pass-on effect onto utilities and energy costs. Do you concur with the view that inflation could come down significantly?
Well, 9% is the target that the Ministry of Finance has communicated to the central bank to achieve by June. I think a few things will have to go in the favor of the economy and of the central bank for us to achieve that. But it's not inconceivable that we could be in the 9 to 11% kind of range by June.
What about the fact that this is an election year? And we know in an election year, government wants to impress. So lots of social projects are embarked on, lots of infrastructure spending. So effectively, these should start creating inflationary pressures on the economy.
I think it's going to be difficult. I think the government's fiscal deficit is already running at fairly high levels. Financing that has been a challenge. I think the central bank is far behind in the borrowing program for the year. So far, they have only covered about 18 billion, which is about 15% of the total borrowing requirement for the year. So really, though in an election year, the government would like to increase the spending and do a lot more on social spending, I think it's going to be a challenge this year.
For businesses, what does this central bank decision mean? Because businesses have actually had to negotiate with banks and the government to cap the lending rates on the debts that they need to service, because we've seen rising debt costs in Kenya, both for the consumer and at a commercial level.
Certainly, the increase in interest rates that the economy has witnessed in 2011 has been extremely sharp. There is a great risk of increase in defaults on bank loans this year, and the stability of the banking sector could get affected by that. The banking sector as a whole has taken a unified approach to providing relief to lenders, to the borrowers, and to try and extend the repayment periods. But I think this is going to be a key risk for 2012.
And for those investing in Kenya through the capital markets, how do these interest rates compare in terms of making bonds and fixed income assets attractive in general?
Well, bond and fixed income investments at 20% plus are quite positive for domestic investors. For foreign investors, I think it will have to be looked at with the exchange risk, because I think we will see a period of instability on the exchange rates during this election year. So it's a balance of high interest return, but possible exchange risk.
Okay, obviously moving on to the equity side of the market, we've seen Kenyan companies to a large extent underperform as the market came down over 30% in 2011 because of a lot of international and domestic variables, the drought, for instance, the rising inflation. Valuations make it attractive to seek bargains in this market. But what are the returns on equity for anybody coming into a market that's down, especially when interest rates are at 18%? Where do people make money in an economy like Kenya?
2012 is a tough year for investments. Valuations in the market are certainly cheap, but I think one has to look at longer term returns. I think this year, with the interest rate environment continue at very high levels in the first half of the year, and with elections in the second half of the year, I think people should not expect too much from the equity markets in 2012.
And just finally and very briefly, where's the opportunity in general? Growth is expected to still be rising up, and sectors are expected to recover irrespective of what's happening internationally. The general macro fundamentals for Kenya, do they look good?
For the long term, the prospects are certainly good. I think for that, but for the short term, I think investors should not expect to make quick returns in this market.
All right, Sunil Sanger, thanks so much for your time, and compliments of the new year to you. He's an independent financial analyst joining us from our studios in Nairobi, Kenya.